We can never know anything about them, right? But the most important part about this is it's making me late, it's making me wait. But also when it comes to the stock market, those who are anticipating the worst to come may be losing out, right? I think it's hurting a lot of folks, and a lot of market participants are probably losing a lot of money. So I want to bring in now two economists who are just really extraordinary in what they do, and discuss where exactly we are, where we're heading. Our economic power panel, former J.P. Morgan Chase, their chief economist, Anthony Chan, along with FHN Financial chief economist, Chris Lowe. And I got to start with today's data, guys. Personal income and data came in pretty good. I mean, people were a little bit worried about the income number down 0.4%, but a big chunk of that was two government programs. Overall, we did see, we saw services income up pretty good. I think that was up about 30 billion. Goods income were up, Anthony. So, I mean, that number wasn't too alarming. Where are we with respect to it feels like steady as she goes.
I'm very excited with the numbers. I mean, the numbers are just telling you that consumers are still holding in there. You saw goods consumption a little bit weaker, and of course service a little bit higher. That was front running because of the tariffs. So people were buying in anticipation, to use that Carly Simon phrase. But now they're basically pulling back. But overall, it's pretty steady. On the inflation front, we did get a little bit of an increase, 2.7. And of course, the Fed's target is 2%, but we're not that far away. I think at some point this year, the Federal Reserve is going to cut interest rates. They may not be in a rush because they might want to see a little bit more of the impacts of tariffs and what that will do to price and things like that. But I think they have an asymmetric bias towards easing, and that's going to be reflected sometime before the end of the year, no doubt.
I feel like their bias, though, I'm glad, I'll borrow your word this time, Chris, has changed, though, and it's a bias, and I'm not sure why. You know what bothers me, guys? So forever, Jay Powell says that the most important job they can do is to contain inflation expectations. Right, that's what their job is, to make sure they contain, tamp down. Well, if the Fed's expecting inflation to go higher, shouldn't everyone else? I mean, I feel like in the last FOMC meeting, they violated their own principle because they said we're no longer data dependent. We had months and months in a row of lower inflation data, so we're not going to be data dependent, as we said. That was one of the hallmarks of the Powell Fed. Instead, we're going to anticipate higher inflation. If that's the green light from Main Street, Chris, to anticipate higher inflation.
Well, no, it's exactly right. Everybody looks to the Fed as the premier forecasting body. If they say they're worried, we're going to be worried. I would even take it a step further than that, too. They always tell us we're not on a predetermined policy path. Well, what does it mean when they say we will not cut rates until we're certain about what this tariff policy does to inflation? In other words, they're on a predetermined policy path until they know what's going on with the tariffs, which could be months from now.
The core, so Powell invented the super core, and a super core was 0.13. Again, this is his own metric that he told us to look at. And so if I'm at the Federal Reserve, I feel like there's maybe even more pressure on me right now to act. Listen, they don't have to worry about July, but it still hasn't materialized to the degree they said it would.
No, I agree with you, Charles. But reality is that you're right. July is not really a live meeting. Some people want it to be. But if you look at the futures market, they're now projecting about a 20.7% probability of a cut in July.
Right.
It's not until September where that probability goes up to 90%, higher than 90%. But the reality is that when you look at, I just wrote a Substack article on this topic, if you look at inflation expectations, and I like to look at the break-even rates of the Treasury market, if you look at that, that has actually creeped higher since the Federal Reserve started cutting rates back in September of 2024. In fact, in 2024, when you look at the PCE, it was 2.1% and 2.5% on the core. Today, we're higher on both of those things, so they've cut rates. And guess what? The markets are worried about inflation. Not to say that I should be worried, but they are. And the proof of that is mortgage rates and the 10-year Treasury yield are up over 50 basis points since the Fed cut rates by 100 basis points. So I think that's their concern. I'm not as worried about inflation, but those are the arguments they're using.
Although they cut rates, to your point, in a scenario that was very similar to this. And so folks are wondering, why would the urgency last year to cut, particularly that 50 basis point cut, and not the urgency now on the very similar circumstances. And more recently, the yields are coming down pretty quickly.
I'm on your side.
Yeah.
I now look at the data, look at the inflation data from back in September 24 to now, and I can't see why they had to cut rates in September 24. But at the same time, I think this year, as the economy slows, and it will slow, even though the Atlanta Fed is telling us that in the current quarter, we may see economic growth of 2.9%. People will say, oh, but you got a 0.5% contraction in the first quarter.
Right, that offsets
so 4.7% contraction because of the contribution of imports,
Right.
because of the tariffs.
Right.
That's going to be completely offset in the second quarter.
So then how are you seeing this, Chris? And more importantly, obviously now that we've had this conversation for a few weeks, but now because the Journal talked about it yesterday, everyone's talking about the potential shadow Fed or announcing maybe a replacement earlier than normal.
I think the way I look at it is you average the first 2 quarters growth. If we're running at 2.9 in the second quarter, it's 1.2 in the first half. That's consistent with the consumption data we saw this morning. It wasn't horrible, but consumer spending has fallen in real terms 3 out of 5 months this year. You put that together and it's slower growth, which is also consistent with a 30% slowdown in payroll employment growth as well. The economy is slowing. And inflation, it heated up a little bit in the latter part of last year, and it's cooled off a little bit in the beginning of this year. I think it makes perfect sense for the Fed to cut. And I think what the president's doing by announcing a Fed chair early is trying to increase the pressure on Powell to cut. And I suspect he says he's got 3 or 4 names in mind. I think while there are other names that are higher in the odds list right now, I think he will settle on Governor Chris Waller. The reason is by moving Waller over into the chair position, he opens up another seat on the board he gets to fill, increasing his numbers. I think it's a better strategic move.
Is there someone in particular that you're thinking about?
I think I agree that Chris Waller certainly has to be at the top of the list. And by the way, there's another sort of wrinkle there. Suppose Fed Chairman Powell doesn't leave. He's got another 2 years.
Sure.
So he can stay on the board. So Waller is there. But of course, Fed Governor Bowman is also talking about cutting rates as early as July. So you can see they're all jockeying for position that would suggest that they are amenable to cutting rates. So the pieces are moving. So
bottom line, though, for our economy, I don't assume either one of you guys are in the recession camp. The soft landing, they do the monthly survey of fund managers. It had gone to, in April, everyone went to hard landing. Now, most folks, I think, it's like a 70% believe soft landing. Can we still achieve a soft landing?
Oh, I think we can. I'm a member of the Blue Chip Consensus estimates, and I've never forecasted a recession in the last year and a half. I did say that the probability was increasing to 25%, but 25% says 75% chance of no recession. And then in terms of the Fed decision, whether the president should make or voice an opinion, I think the president is elected by the people, and therefore the president should be allowed to voice his opinion on Fed policy.
Sure.
Now, the question is, should the Fed be able to control the Fed? That's a different question. And academic studies, one put out by the International Monetary Fund, says that when you do that in those countries, guess what? You get a subpar growth number, real GDP is lower than it otherwise would be, and inflation is higher than it otherwise would be. So there I'm a little bit more cautious.
Real quick, where do you see the second half?
I think it'll pick up, but the key is the Fed really does have to cut rates. We're in a not just a little bit restrictive, but it's actually a moderately restrictive policy place. I'm less worried about tariff inflation than I was a couple of months ago. I think we'll be in great shape.
Yeah, I agree, Ty. And I think, listen, I'm not an economist, but I see what it's doing to regular folks. And I think it's restrictive on the wrong people in this country. Hence, maybe why the president should be speaking up on their behalf. Two legends. Anthony, Chris, thank you both very much. Appreciate it.